Hello everyone, I'm Bob Landaas. Welcome to the Landaas Company 2021 Investment Seminar. Because of the recent uptick in COVID cases, we've again decided to do our annual seminar on video. Hopefully we'll see everybody face to face next year. Our job in this program is to talk about the economy, not only here in the United States, but overseas, to discuss the financial markets, the stock and bond markets, and to talk about possible and probable outcomes. Joining me on the program are a number of my colleagues to discuss specific ideas. And first, I'd like to start by introducing Kyle Tedding, our head of research. Kyle, thanks for joining the program.
Thank you for having me, Bob. I'm happy to be back on this year.
The markets and the economy have come a long way since the lows of March 2020.
Yeah, they certainly have. You know, we've come from the pandemic lows of March of last year, where we lost 22 million jobs here in this country. We've recovered a vast majority of them. The stock market itself come back pretty drastically as well. And so I think there's a lot to be happy about.
As you're well aware, the recovery has been pretty uneven. Huge distortions in the economy, supply chain disruptions, of course, slow return to the offices, and now, as we saw late this summer, return of COVID surges because of the Delta variant.
And I think as we look at some of those issues that you're talking about, I think it's obvious that those have been not only the things that have held us back, but also some of the reasons why the recovery was as swift as it is. Of course, the reality, Bob, is that there's still a lot of potential risk out there from some of those issues, a lot of potential disruption still that can happen. And so I think as we talk about some of those issues, as we talk about COVID still on the forefront of everyone's minds, I think it's important to understand that there may be some reasons to continue to be vigilant, and at the same time, some reasons why we've seen some things come back.
Kyle, after years and years of below 2% inflation came back into the news this past winter. You and I took the position that inflation appeared to be transitory. Preliminary evidence shows that, at least up till now, we look pretty good with that forecast. Because of the supply chain disruptions, lumber is one example where a lot of the sawmills in the United States shut down last year. Very few people anticipated a housing boom, and they were caught flat-footed. Lumber soared in price, has now come down. Used car prices we saw in the springtime were going up literally 10% a month. Nobody thought that would continue. Detroit shut down along with many other automakers last year, and as a result used car prices went up, and literally no one thinks that they're going to continue to go up 10%. And I think it's always important to follow the yield on the 10-year treasury when you're looking at inflation. I think it's important to ignore the politicians. Oftentimes we've seen if a politician doesn't like the way Congress is spending money, they go scream inflation. We saw that 10 years ago. We saw that this past winter. So I think it's important for investors to focus on literally the canary in the coal mine. Look at the yield on the 10-year treasury. If the yields start zooming, get nervous, you got a problem. And what we saw this past winter, of course, was the 10-year treasury shot up to 1.74% in the middle of March, only to go down to roughly 1.2% by July, slight uptick in August. So follow the financial markets. If big money was getting nervous about inflation, I would suspect that the yield on the 10-year would be quite a bit higher.
Well, and let's be clear, Bob, a recovery from the pandemic has been helter-skelter, right? It's been fits and starts. And so we saw some of that inflation that you talked about in certain areas only because you had either a significant supply disruption or you had unanticipated demand. I think that led to a pretty quick spike in the 10-year treasury earlier in the year. Certainly as some of those early signs of high growth took off, but we're starting to see growth moderate now, and I think that's maybe the sign that we were waiting for, that some of the early inflationary pressure is starting to ease, maybe the sign that we might be easing into a more normal growth environment, or even back to what that old slow growth environment was.
With gross domestic product averaging roughly 2% for the last 10 years, a lot of people were surprised to see GDP this year shoot above 6%. That's triple, of course, the normal rate of growth in the United States. So forecasts are now calling for a slowing of the economy. And Kyle, we've seen recently some news out of China that their exports are slowing. Domestic indications show that their economy is slowing, and that could be a heads up to global investors.
And I think we need to be clear that some of the early high growth we saw was maybe just a shot in the arm from the recovery. I think in many ways the idea of slowing growth needs to be maybe delved out a little bit, right? We need to better understand that we're not talking about no growth, right? We're talking about an economy or an environment globally in which growth may just get back to that slow rate that it had already been at. Yeah, you're seeing some signs that China may be slowing a little bit further than what they had, but that's a trend that had been developing for a while. Trees can't grow to the sky, right? And so if China's ultimately reaching a more terminal phase of growth for the Chinese marketplace, then I think it's only logical that that growth starts to slow. Of course, I think as we look ahead, as we look at what growth may look like in the future, I think it's clear now that the many signs we're talking about, that inflation likely was a transitory issue, that the 10-year Treasury isn't pointing to any meaningful signs of long-term growth, I think you've got all the evidence you need there that growth is likely to be a bit more muted.
Switching over to the U.S. stock market for a minute, Kyle, we do have to acknowledge right away here in talking about U.S. stocks that stocks are expensive. In looking at forward PEs for the S&P 500, as of the end of August, stocks are selling for over 21 times earnings. That's a little bit on the expensive side, considering that the last 25 years, the forward PE for the S&P 500 has averaged a little over 16 times earnings.
And I think we need to be clear that it isn't all stocks, right? That the median forward price to earnings ratio for stocks in the S&P 500 is a little bit below 20. So when we're talking about average, right, we're looking at all the stocks in the S&P. Yeah, things look a little expensive relative to historical averages, but that stock right in the middle, if we arrange from cheapest to most expensive, looks a little closer to average than what we've seen in the past. And so I think from the onset, important to understand that it has been maybe a smaller number of stocks that have had extremely high prices. But that said, even with that median price, we are talking about higher forward PEs. I think some reasons, though, to think that maybe that's a bit more supported by things like lower interest rates than what we've seen in the past.
Long term, the studies have shown that a low interest rate environment can support higher multiples. But if you dig into the forward PEs for the market, quite a dispersion between value and growth still. Forward PEs for the growth, large cap growth, 30 times, that's rich. And yet for value, in spite of the run they had in the first quarter of this year, large cap value forward PEs are a little over 16.
And I think what's most interesting about that is that even as the market has run significantly higher this year, we haven't seen the forward PE move higher, right? That the earnings piece has kept up with the price piece. That's been true across the board from growth to value stocks. We started the year with growth very expensive, with value maybe a little bit less than very expensive. And now we're 8 months, 9 months through the year, we haven't seen a drastic change, and that's because the forecast for earnings has been exceptional. 2021, we're talking about 40% plus earnings growth for the S&P 500. As we look ahead to 2022, we're talking about 9 to 10% earnings growth. That's a pretty typical year for stocks. That's a pretty typical year for markets. And so I think there are some reasons to think that stock price appreciation has been supported by the earnings that ultimately back it.
Kyle, I think it's important to point out that historically, when stocks are trading at higher forward PEs than average, it normally serves as an impediment for future growth. So the point simply is that the fact that forward PEs are elevated, at least for the growth part of the market, it could suggest, based on history, lower returns moving forward.
And I think that does influence the way that we view how we should be allocating portfolios, right? That if the expectation for future returns in U.S. stocks might be a little lower, perhaps we need to think a bit more broadly about how we're constructing our portfolio. And so while we always use this idea of balance as kind of the guiding force, I think that idea of balance does change a little bit over time based on some of those expectations.
So we have interest rates that are historically very low. The long-term average for the 10-year Treasury is over 5%, said a little over 1% now. Earnings growth looks pretty attractive going into next year. So at this point, I'm guardedly optimistic for the future for equity returns. But I'm also cognizant of the fact that when the Fed starts tapering, that it can be volatile for stocks. Historically, it has been. When the Fed's raised interest rates, the first time the Fed raises in the cycle, the street's attitude is, oh, you guys are finally doing something about inflation. That's good, and stocks tend to do well. But historically, by the third Fed rate increase, the street's attitude shifts towards, oh, you guys must be really worried about inflation if you keep raising rates. So stocks can be volatile. And now we have, of course, the Federal Reserve, $120 billion worth of bonds every month. They've already given the country a heads up that they're going to reduce bond buying perhaps as early as late this fall. And that can be volatile for stocks. Kyle, as you know, it's been a long time since we've had a 10% correction, almost a year and a half. Been a long time before we even had a 5% correction in the market. And it's important for investors to remember, on average, we get a 10% sell-off every 18 months to 2 years. The way I look at the calendar, that tells me one is coming. Need not be a reason to make major changes in your investments. But I think that we manage expectations as much as we manage money, and it's important for people to remember that stocks don't grow to the sky.
And I think expectations are key, right? We've lived in a market for the last 18 months that's been driven largely by fiscal policy, by economic policy, by monetary policy. And so I think we've had this support, and it's right to think that as the Fed changes the way they're viewing markets, as the Fed changes the way they're viewing their role in economic growth, there may be some effect on stocks. And so I think investors need to be aware of what the Fed is doing. It's certainly something we pay a lot of attention to. I think the one saving grace we've had, especially since the financial crisis, is that the Fed has been crystal clear about what their intentions are. They're not leaving it to chance that investors are going to be caught off guard by what they intend to do. And so slowing bond purchasing, allowing some bonds to roll off the portfolio as they mature to reduce the size of their overall balance sheet, those are all things that are maybe in the near-term forecast for the Fed. I don't think that necessarily means that rates need to move all that far, certainly, but it does mean that there are some changes afoot as far as the Fed is concerned.
Still to come for the economy and the markets is a $3.5 trillion spending program that's now being discussed in Washington. That's a lot of money, Kyle. That'll have a big impact on economic growth moving forward. They think there's still a lot of pent-up consumer demand. People have been saving quite a bit of money since the pandemic started. Higher saving rates, of course, means that people get to spend more in the future. We've yet to see really increases in productivity growth. And as you know, that's so important to the economy. GDP is basically increase in the workforce and increase in productivity. How many pens, hypothetically, can you make an hour? And productivity growth has been anemic after huge increases in the 60s, 70s, into the 80s. But for the last several decades, output per man-hour worked has been somewhat stagnant. So I'm a little bit encouraged to see that productivity growth has been climbing. Granted, that's somewhat typical climbing out of a recession. But I think potentially we have that to look forward to.
And maybe start with the fact that it is typical coming out of a recession to see that productivity growth improve pretty drastically. You have workforce reductions typically, even as production tends to keep up or at least slow less fast than what the workforce is slowing at. And so I think typical to see that. It is one of my favorite things to talk about, though, because as you mentioned, long term, it's the force behind economic growth. We aren't seeing significant shifts in our workforce anymore the way we did even 30 or 40 years ago, but certainly now productivity growth is even more important. So as we talk about the impact of the pandemic, I think the lasting impact is really going to be what kind of gains we can see in terms of productivity. It's a significant transition to a more mobile workforce, a significant transition to a more technologically savvy workforce. These are all things long-term that make workers more productive. We aren't fully there yet. There's certainly plenty of gains that can still be made, but I think much of the productivity growth we've seen in the last 18 months was forced upon us, and it's up to us now to build on that to continue to drive economic growth.
Of course, we're still in the infancy of artificial intelligence, augmented reality, machine learning, and other wonderful technologies that eventually should come to fruition and help output per man-hour work. Of course, the reason why we talk about this is it's really one of the few ways to increase aggregate net worth in the United States, have more workers and make them more productive.
And of course, it increases wages as well, right? If you can be more productive as a worker, you're worth more to your employer. And so if inflation is a concern, and some reasons to think that there might be small inflationary pressures, but as we mentioned, most of the inflation we've seen has been transitory, but the best way to combat inflation is to increase wages along with it. And so a more productive workforce also gets the benefit of those increases in wages.
Kyle, for the last 11 years, we've seen growth stocks, those with above average PEs, dominate the landscape. It was quite refreshing to see that value stocks came back in the first quarter. Of course, below average PE stocks, they've been in the wilderness, if you will, for a number of years. Pretty simple explanation. We had a big increase in the rate of growth in the economy, and that typically favors value and the cyclicals. And then, you look at growth coming back in the second and third quarters, and now through the end of August, kind of a horse race between large value and large cap growth.
We used to put up slides in the seminar talking about just how big the performance gap was between those growth and value stocks. And it was almost staggering because for years, I know you and I had conversations about how it always used to be value, that over those extended periods of time that led the way, right? That if you could buy something cheap enough, it was always going to be worth more. And then the economic transition to favor many more of these technology stocks, stocks that have higher profit margins than some of the industrials might have had in the past, they all of a sudden became much more in favor. It was encouraging to see that value stocks had a nice recovery as the economy started to accelerate again. I think it's as encouraging to see that they haven't completely fallen by the wayside as growth started to slow again. They're still participating. They just maybe aren't leading the way they had been. And so I'm encouraged by the fact that it's been a broader based recovery than what we've seen in many other cycles like this. I'm encouraged by the fact that you saw value perform the way we would have expected in the exact environment we thought they'd do well in. And so it's just a function of continuing to see economic growth move forward, even if more slowly, to continue to support some of those cheaper stocks in the market.
Kyle, I think it's impressive that just 5 stocks account for 25% of the total value of the S&P 500. To support that value, though, of course, those 5 stocks also represent approximately 25% of the earnings of the broader markets.
Yeah, incredible how that works out, right? That if they're about 25% of the earnings, they fit into about 25% of the overall picture. Of course, important to remember in economic perspective that if you're talking about labor force, they're not 25% of the U.S. labor force. If you're talking about kind of corporate spend, it's not 25% of the corporate spend. And so in some ways, the S&P 500, any number of other indexes, maybe not completely reflective of the economic landscape. It's one of the things that allowed stocks to recover more quickly than the economy did following the pandemic. It's also one of the reasons why if you focus a bit more broadly on the market, if you focus on those stocks that you think will do well and avoid those stocks that you think are going to do poorly, you have the potential to do better than the economy as a whole is going to do. We know that there might be as many as a third of the stocks in the S&P 500 that are facing meaningful disruptions to their business. Stocks that may not be around, not even 20 or 30 years in the future, but 5 to 10 years in the future. And so there's plenty of reasons to think that if you can be a bit more broad in terms of how you view investing, you've got a lot of opportunity in front of you in terms of capturing strong return.
Kyle, more and more managers, as you know, are talking about disruption as a major investment theme. The idea of capitalism, one of the cores, of course, is creative destruction. money always migrates over time to a higher and better use. So it's somewhat unsettling to read that they think a third of the companies in the S&P may not survive even the near future. But of course, with losers means you have winners, and those, of course, what you want to focus on.
I think, a great example of that is looking at anytime oil prices start to dip, you see marginal producers, those producers of oil or those people that take oil out of the ground, those that can't produce at lower costs stop producing or they're going to lose money. And we're going to continue to see those kinds of disruptions as clean energy becomes more affordable, as it's easier to build a solar farm or a wind farm than it is to extract another barrel of oil from the ground. You're going to see more businesses in those kinds of markets and less in some of the older fossil fuel markets. There's plenty of examples out there like that. When you look at the Kodaks of the world who used to produce film, you don't have film cameras anymore, and so it's no wonder that those kinds of businesses get disrupted. It's a natural extension of what we do, making sure that we're investing, making sure that we're focusing on those things which have the viability long term, and trying to avoid those things which are going to be disrupted out of the market.
Kyle, big picture, long term, we try to anchor much of what we do on the efficient frontier studies. And I marvel how the results don't change much year to year when we do 30-year lookbacks. Every year the results are somewhat the same. You want to talk about that?
Yeah, this is one of my favorite slides we pull out every year for the seminar, and I think it really speaks to the core of what we do, and that is trying to navigate the right level of risk. We spend so much time talking about return. What kind of return can I expect? Long term, is this return going to be sustainable for what I need from my portfolio? I think as important is a conversation about risk, and when you marry those two, you get this idea of the efficient frontier that the more risk you take in the portfolio, the more return you should expect. Unfortunately, there's a point in time in which taking more risk just doesn't add enough more return for it to be worthwhile. And so we have tended to find that if you add a little bit of high quality to your portfolio, you take a lot of the risk away. You don't lose that much return. You add a little bit more, you take a lot more risk away. And there is a sweet spot. There is a right place to be in terms of how much bond do I have in my portfolio, how much stock do I have in my portfolio, how do those pieces fit together. That right mix changes a little bit over time, and it changes depending on who you are as an investor. But there is a right place to be, and it probably isn't all or nothing.
Of course, risk is a good thing and a bad thing. If you look at how Morningstar really got started down in Chicago, it was to help educate investors that an 8% return is not a better deal than a 7% return if your 8% return involves significantly more risk than the 7% return. So they started with a risk-adjusted return calculations, and the broader investment community over the last 30 years has embraced that, so that we try to build balanced portfolios cognizant of our risk levels, and try to maximize our return commensurate with a reasonable amount of risk.
And I think the challenge we have now, Bob, is that some of the things we traditionally rely on to reduce risk, those bonds in our portfolio, they're not yielding as much as they used to. And so there's a tendency for investors to look at that and go, what could I potentially do to get a little bit more here? We need to be careful there.
Well, of course, it's human nature to want to make more money. People look at their short-term returns and what's not to like about what the stock markets have produced. But it's important to remember that rallies don't last forever. Eventually we do get corrections. Eventually we even get the bear markets. And Kyle, over 40 years of managing money professionally, the people that I've seen that have done really well at maintaining and growing their wealth keep their head in the game. They remember that investing is about long-term investing. It's not short-term market timing. The easy part is getting out. The hard part is getting back in. But so many investors feel like they need to do something about their portfolios when in many cases the best thing to do is tighten your seatbelt and ride it through.
And sometimes it's to do the opposite of what your intuition, right? If you think you should be running from something, it may be better to stick around and fight it out. It may be better to, in the middle of a downturn in the market, not sell out of that risky stock, but buy a little bit more of it because it's gotten cheaper. And so I think, that's part of the conversation about why we build that balanced portfolio is you need that anchor to windward. You need that ability to know you've got yourself covered so that when you get an opportunity, when that cheap market comes along, you can lean into it a little bit instead of running from fear.
And speaking of fear, the behavioral scientists have figured out that we're all hardwired to fight or flight. That when the average person is confronted with danger and risk, that we're hardwired to either run or engage. And on average, you don't want to do either one of those. And if you're tough enough, you may want to buy when markets are depressed. So interest rates are low. The bond market is a critical component to investment portfolios. And we should remind investors why they own bonds. Interest rates are low. It's unlikely that returns are going to be even on average with historical returns. And the whole point of bonds is that it gives you the courage to own stocks. The whole point of bonds is that if you're retired, you want to make sure that you have a number of years of your withdrawals where you're almost positive about the stability of the money. That's why you own bonds. We know that it's impossible to predict the future. Normally forecasting is challenging. Coming out of a pandemic, I would suggest it's almost impossible. We don't have in our playbooks answers for the last 3 or 4 times that we came out of pandemics, this, and this happened. So there's very little to rely upon with any degree of accuracy. And you own bonds because it's just really hard to predict. I can come up with all sorts of reasons why I think stocks are going to do well next year. I can come up with plenty of reasons why that might not be the case. So it's hard for people to fully appreciate the role that bonds play when stocks are doing really well. The next time the market goes into a correction or even a bear market, people tend not to complain about the bond part.
And I think we look at the stock market and we see all these various components, whether it's looking at value and growth or looking at all the various sectors. We sometimes forget that the bond market is maybe even more diverse than the stock market, that one bond is not the same as another bond just because they're called bonds. And so I think it's important to understand that there are going to be opportunities in different places with the potential for changing tax rates. Municipals look like a pretty interesting idea. With low interest rates, you might be tempted to reach for maybe some higher yields in some places. But remember that many of those higher yielding bonds don't carry the same quality. And so I think there's a significant challenge to just lumping everything into that bond category because the opportunities are going to be very different, the risks are going to be very different. And so understand why it is you're holding the bonds in your portfolio. It's not to capture those high-flying returns that you're going to see from stocks. It's absolutely to provide that kind of foundation for what you want to do with the rest of your portfolio.
Kyle, you spent a fair amount of time in your career looking at high yield, lower quality, what some folks refer to as junk bonds. The spread between junk and high quality, similar durations or maturities, average roughly 5%. Spreads are quite a bit narrow now, and that's kind of a heads up to the investment community to perhaps stick to quality.
Yeah, we really just aren't seeing investors being compensated for the risk in that lower quality space. And I think that's the key is if you're going to take risk, you want to be paid to do it. That's the name of the game. And so where we're taking risk in our portfolio, it's going to be in the equity side right now. It's going to be in stocks because there's more opportunity there. I love the idea of high yield bonds. They sound great because you get higher yield, you get that higher interest rate. I love the idea of some of those high yield bonds, but only when you're being compensated to take that risk. Those windows tend to be fairly narrow. We see spreads blow out, meaning you're getting paid a lot more for the risk of taking those bonds relative to a higher quality bond. The challenge, of course, is that if those windows are narrow, it requires you calling the top right and calling the bottom right. And so there isn't a lot of opportunity out there typically, and especially right now, many of those lower quality bonds just don't look all that attractive. And so we really have been focusing on higher quality. We really do want investors to understand the role that bonds play, and it isn't to chase that return, other than those very few environments where there is a little bit more return to be had.
President Biden has announced recently that he intends to raise income tax rates for the highest earners back to 39.6. And that's led to renewed life in municipal bonds. In many cases, they're exempt from federal tax. Some munis, of course, are exempt from state and federal taxes. But I've enjoyed the rally in municipals and the support that they're getting. And it's, I think, an opportunity for some folks.
Yeah, higher tax rates would certainly make that even more attractive. And I think that's some of what's driven early returns there. I think the reality, though, is that especially for higher earning investors, a piece of municipal bonds in your portfolio, and that taxable piece of your portfolio, tends to make a lot of sense, right? That you can reduce some of your tax burden as long as you're getting compensated fairly for that benefit. It makes all the sense in the world. I think there are some challenges as we look at municipal bonds, particularly the more focused you become. You talked about some of those double or triple tax exempt bonds. If you get too narrow in your focus, you tend to hone in on some very specific risks, whether that's longer dated or longer maturity bonds, or whether that's bonds in some lower quality areas. And what we really want to do is make sure that, again, just as our conversation with bonds a bit earlier talked about, is that we're getting compensated for the risk we're taking. And so investors need to know that there's lots of different ways municipals can make their way into the portfolio. A lot of that has to do with your own individual tax rate. A lot of that has to do with what the opportunity set is for you. But I do think that, at least in the current environment, municipals make a lot of sense.
Kyle, you mentioned just a minute ago about the diversification in the bond market. I think it's important for investors to remember that the very different types of markets, munis trade very differently than governments. They trade very differently than corporates. So for many investors, it's important to own different types of bonds, not just a numeric diversification, but own governments, own corporates, own agencies, and for those where it's suitable, to perhaps even own municipals.
Yeah, a risk we don't often talk about is the ability to sell that bond that you have. And the challenge, of course, with municipals is that most buyers are individuals. Individuals are the one that pay those taxes. And so municipals are most attractive to individual buyers, whether it's through a packaged mutual fund or whether it's the individual bond itself. And so varying the degrees of risk within your bonds by diversifying the types of bonds you're holding, I think, is critically important to making sure that you can diversify your overall risk.
Kyle, let's switch gears, go overseas, talk about the international equity markets. International stocks have lagged U.S. domestic stocks for quite some time now. There's a reason. They're less expensive because their economies have not recovered as the United States has from COVID. The dollar is strong, relatively speaking. There's no place like the USA when times get tough and money is poured into the United States. But you and I are long-term investors, and it's getting hard now to ignore the attractive values overseas, knowing that at some point in time the dollar should inevitably weaken, if for no other reason because of the size of our deficits and the idea that they're about to go up even more in the near future. As we know, the pros normally recommend 15% of your money overseas. We've been underweight for the most part, but now you look at the valuations, quite a bit less than what you pay for stocks here in the United States. For long-term investors, I think that's going to start looking more attractive.
And candidly, we've been underweight because the opportunity set here in the U.S. had been far greater for a very long time. I think what has changed is certainly that some of the valuations outside the U.S. look much more attractive. We talked about diversification before with bonds, with stocks, whatever it is. I think the major benefit to having international in your portfolio, no matter the times, but just international as kind of a default piece of your allocation, is that there are so many businesses you can't capture by being a strictly US investor. You want exposure to European power producers or African power producers, you've got to look outside the US for that. And there are so many examples of great businesses that just don't either exist here in the US in some form or fashion, or that are just completely out competing US businesses when you look outside the US. And so I think you want exposure to a variety of sources of risk, a variety of sources to potential return. That has to include at a minimum some of these opportunities we're talking about outside the US, just as a default position. Now you add in some of these great opportunities we're talking about with valuation, add in the potential for pretty significant growth of the emerging middle class in much of the emerging world. I think there are many reasons to think that looking outside the US as a greater portion of your portfolio is a good opportunity right now.
You and I have become less and less interested when we look at opportunities overseas in focusing on where the company is domiciled. And we found that it's way more interesting to focus on where they do business, what is their market share, and how do they see that growth in the future.
Yeah, let's be clear. It doesn't really matter anymore in this global economy which country your headquarters is in. It doesn't matter that you're a US-based technology company, because there are Facebook users all over the world, there are Google users all over the world. If you're using their services, it doesn't matter for the most part what country you're in, outside of a few that ban those specific services. But your revenue sources are much more varied than your country of domicile or where your headquarters is located. And so I think as we look at the investment landscape, and as it's changed over the past 20, 30, 40 years, it's become increasingly important to look at revenue exposure, increasingly important to understand, yes, this is a US-based manufacturer of consumer goods, but they do 60% of their business in China and Europe. And so if our outlook for China is that growth is going to be slower, but certainly faster than here in the US, that's an exposure you might want. And so it isn't necessarily about getting a Chinese consumer goods manufacturer, it's about getting a consumer goods manufacturer that has exposure to China.
Kyle, of course, the classic reason for U.S. investors to put a piece of their money overseas has been to reduce risk, that there has been historically lower correlation between the U.S. markets and overseas markets. That's changed, of course, over time with globalization, and they don't necessarily move in lockstep, but the correlation is getting closer to one there. But it can serve as a risk reduction technique.
Yeah, and some of it is currency, right? That currency moves tend to offset each other. And so if part of what we're doing is investing in other currencies and companies from overseas, you can reduce some risk that way. Some of it is also that there are just businesses, as we mentioned, that you can't capture here in the US. And so if you want those businesses, if you want to be able to reduce your risk by more broadly diversifying, you look overseas for it. And so I think it's important to understand not just what's the overall country exposure, but understand what kind of risks am I exposing myself to by doing this. Variety of ways to measure that, and certainly that's something that we take a pretty long and hard look at when we're talking about which particular portfolios, which particular international managers we might want to add to our portfolio. But I think it is critical to understand that one of the main benefits, as you say, is that risk reduction.
Basically, the United States dominates large cap technology companies. There are a handful overseas, and I suspect one of the reasons why U.S. stocks have done better than the international equity markets is because we dominate big tech.
Yeah, I think you look at the changing landscape of what has been a transition to technology businesses. They are some of the highest margin businesses you could ever invest in, and it's one of the reasons why growth can be as high as it is, because every new user goes straight to the bottom line. You don't need to add much in terms of operating costs with these technology businesses to add another consumer of the product. And so profit margins have been far higher. It's why I think many of these US businesses have been the ones that have seen the highest returns. Of course, those kinds of things come in cycles. We see productivity gains in manufacturing as a way to improve profit margins. It's certainly going to help the returns of some of those non-technology businesses. I think the other piece, of course, to remember is that as we look outside the U.S., again, it isn't strictly technology. Should we find issues here within the U.S. in terms of regulatory issues with many of those technology businesses, and we've had a number of conversations about potential risks to those businesses from the Senate, from Congress, from them trying to regulate some of the content that they put out there, I think that eats into some of their profitability, and so it's one more reason why you want to find a diversified source of returns.
Finally, Kyle, as long-term investors, I think it's very important to look to the future. At some point in time, we're going to be in a post-COVID world, whether it's a year or 2 or 3 or more years. My guess is we're eventually going to get our hands around the problem. And it's important, I think, to envision life after COVID. I think it's important that we not extrapolate our current condition into the future. That's how most investors act. They tend to look at their most recent perceptions of the markets and act accordingly, or the most recent perceptions of the economy. But at some point in time, COVID will be in the rearview mirror when you're in the middle of it. I think it's hard for a lot of people to do just that, look forward. But as long-term investors, that's the key to the game.
Headlines are scary, Bob. You look at things that are in the news right now. You look at the world that we've come through in the last 18 months. There's been no shortage of things that would make you uneasy, not just about being an investor, but uneasy overall. And so I think it's only natural to really start to think, what does this mean for my portfolio today? Of course, I think that the saving grace in all this is that we've already thought through that potential liability. We've already thought through that potential risk. It's why we build that diversified portfolio. It's why we've got that critical foundation of safer investments. And it allows us to really take that longer term view. It allows us to go, not just how painful is this going to be over the next 1, 2, 3 years, looking even maybe a little bit longer than that, and looking to what kinds of positive benefits might come out from that. We talked about immense potential for productivity gains. We talked about the changing dynamics of the world. I think all of those are things that if you can get past the next 3 years, if you can get past COVID, some of the immediate concerns that are out there, and start to look at this immense potential, it's why long-term stock investors are so successful. They don't have that short-term focus. They really can look at an investment and go, yeah, here's 3 things that might be a problem in the next year or 2. But when you look at the core of this business, or when you look at the core of markets, there's a lot of reasons why you should be pretty encouraged about what the longer term looks like.
Short-term cautious, longer term, pretty optimistic. Kyle, thank you.
Thank you, Bob. Every year at our investment seminar, we like to discuss markets and the economy more broadly, but we also like to get a little deeper into certain investment topics that are important right now. Joining me now to talk a bit more about the participation in market rallies, here's advisor Dave Sandstrom. Dave, it feels like we've gone through periods in time in the market where there's a small number of stocks that really have led the market higher. And of course, there's some reasons why that is, but as importantly, there's some ways we measure that. Can you tell us a little bit more?
Kyle, I think you're referring to market breadth. It's an indicator that measures how many stocks or how many companies are participating in the market's current direction.
And as we think about some periods in time in which it may have been a small number of stocks leading higher, there are certainly reasons why that would be, right? So you go back to the FANG stocks that had really been the key to driving things higher for much of the last couple of years. I think, critical to understand why.
Kyle, it's a good point, and I think one of the time frames specifically was during the pandemic when people were quarantined and those tech stocks really had the ability to penetrate homes, reach those customers, and we saw periods of time where just a handful of stocks were driving the market substantially higher.
Some reasons why investors might be worried about that, right? That if it's only a small number of stocks that are really the key to market returns, the broader economy may not be participating.
That's correct, and I know that we'd like to see broader participation, right? I mean, if we have more and more companies participating in the upside, typically an indication that it's a healthy economy, and not necessarily so with only a few companies participating. But to your point, certainly doesn't mean that there isn't good reason why those companies are doing well and why it can't continue.
And I think what's interesting is that we've seen a transition to more businesses, to more companies participating in those days where the market runs higher.
You know, and I think to your point earlier about there's a good reason for that. This year the economy is reopening, right? So we have much broader participation with corporations in this country being able to access consumers again, people getting back out. So yes, participation has broadened greatly.
And to maybe take that a step further and say that it isn't necessarily even just about a small number of stocks or a small corner of the market, but to look even more broadly at growth versus value as an example. Those technology names that we often talk about kind of fill that growth side of the bucket. There's a reason why growth may be an area that tends to lead.
That's correct, and it's because, you know, that's, you know, by definition, growth stocks are going to pour all those profits back into growing that the value for shareholders and keep that thing going. But I think it's to really look at it from a standpoint of as an individual investor, it's the diversification in the portfolio that is the important piece to that, because we don't want to make a guess on value or growth or any sector in particular. We want to make sure that the portfolio addresses all of those sectors so that when market breadth does narrow, we don't miss out. We're still going to gather some of that return.
And I think that's critical, right? There's always this question of what do investors do with this information? What do we do with the idea that it's a small number of stocks that's leading markets higher? And there's a tendency to want to chase those ideas. There's a tendency to want to say, okay, you know, these 10 stocks, the largest 10 in the S&P 500 account for roughly 30% as an example. If those are the 10 names that are moving higher, you want to put more of your portfolio in there. But I think there's also maybe some reasons why you might want to think more broadly about the world.
Yeah, I think it's dangerous to take one indicator such as market breadth and make comprehensive decisions for your portfolio based on that. You know, we saw it last year in 2020, that narrow market breadth that we talked about, it abruptly changed this year as the economy reopened. And if you would have adjusted based simply on that particular measure, you'd have been in trouble this year as far as missing out on a much broader participation.
And of course, no reason to think that it may not be a different 6 or 7 companies that lead the next wave of recovery.
Correct. So that's why that diversification is such a critical piece of portfolio management.
You know, as we think more broadly about our portfolio, we talk about market breadth within the stock market, but I think it's fair to also point out that within different asset classes, we can see leadership change, right? That it might be stocks that carry your portfolio for a while, but you know, at some point in time, stocks are going to have a correction, stocks are going to have a bad day, and you need to look to other pieces of your portfolio.
Yeah, those other asset classes are going to be critical in keeping you out of trouble, Kyle. And we've seen it recently as well with the bond market having tremendous returns in 2020 and struggling a little bit this year. So you see that shift can occur even on some of the safer assets, but certainly you need those to provide that ballast for when the stock market starts to go through some of those changes.
Dave, thank you very much.
Kyle, it's a pleasure.
Market corrections seem to be a topic that's on every investor's minds. Not just the how and why, but also the when. Joining us to tell us more, advisor with Landaas Company, Paige Radke. Paige, we get no shortage of questions about market corrections. Certainly a thing that is on many investors' minds. I think important maybe to have a working definition of what a correction exactly is. Can you tell us a bit more?
Yeah, so a market correction is anytime you have a downward movement from the most recent high of 10% or more. Now, if you go above 20%, that's when you start entering the bear market territory.
And so let's focus on corrections here for just a minute. They're not exactly a rare occurrence, right?
No, not at all. Market corrections are actually very common and a normal and healthy feature of market dynamics. Since 1980, there have been about 37 corrections with an average of about 13% for each one of those.
And so as we look at those market corrections, we have an idea of what average looks like. I guess the other question, of course, is what kinds of things lead to market correction?
When it comes to what triggers a market correction, it can be pretty much anything. It could be a small shock to the supply chain. It can be concerns of inflation. It can be, even something that we might not even recognize. It could just be market trades and market movements. But the important thing to remember is that they oftentimes are very short-lived. And it's important to just remember that even though the market has gone down, it's not necessarily a bad thing for investors.
And so I think that's part of what makes corrections so common, is that they do have any number of causes. Of course, the other question here is, what we tell investors to do when it comes to preparing for a market correction, what to do once we're in a correction. Any tips?
Yeah, so the number one thing to keep in mind when it comes to preparing for a correction is, like we said, it's very difficult to predict. And so what you have to do is always have in mind what your portfolio should look like, what level of risk you're able to stomach, and frequent rebalancing is going to be what keeps you there. The other thing that you want to do is make sure that you have diversified assets within your portfolio. You have to remember that not all assets are going to react the same when the market does go down. When the stock market has been doing really well, I think it's easy for investors to try to move away from their bond allocations in their accounts. But you have to remember that those bonds are the things that give you the courage to hold the stocks when the market is going down.
So, of course, we've now prepared for the correction, but as we know, they're going to come. They are inevitable. And so now we're in a correction. What should investors be thinking about doing with their portfolio?
Once you enter a correction, the most important thing to do is not panic. Panic leads to overselling, and it just becomes a self-fulfilling prophecy, which will just cause the market to go down further. Other than that, as long as you've been rebalancing your portfolio, keeping it within your risk tolerance, the only other thing that I can suggest is looking for some other things that you could do to take advantage of that market. Think tax loss harvesting. If you have big distributions that you have to take, it might be better to take them out at those lower asset values and let it ride up then in one of your more taxable accounts.
And can't stress enough that market corrections create opportunity, right? Opportunity for some of the things you talked about, but also opportunity potentially to put your foot back on the gas.
Exactly. So if you have been taking money out of the market, or if you were sort of waiting for that entry point as you had concerns about a possible correction on the way, that's the time to actually start buying rather than to start selling. And the same goes for the actual mutual fund managers within your account. They also have some cash on hand, and when you see a correction, it gives them those entry points that are a little bit more appealing that they can then also ride up.
Thank you so much, Paige.
Thank you.
The measurement of risk is one of those concepts that's incredibly important to the way we build portfolios. There's a variety of ways to measure, a variety of ways to consider it. And joining me now to talk about that is Chris Evers. Chris, we spend a lot of time talking about market corrections. We spend a lot of time talking about the potential for portfolio declines, but I think what we really care about is how we measure some of those risks. Ultimately, we have tools like standard deviation and beta, tools we use to talk about how much a portfolio bounces around or how much it bounces around relative to a benchmark. They're great tools, but they have some issues.
Yeah, standard deviation and beta are great tools in that they're agnostic to the sources of risk. They incorporate a lot of data within those two tools. They give you an idea of price variance and the bouncing around of stock funds, bond funds, or your portfolio as a whole. But the issue with standard deviation and beta is that they're entirely based on past price history. So all they really can incorporate is things that have occurred in the past that have affected the prices of those assets. So they're not always great at forward looking or handling unprecedented situations that maybe haven't happened in price in the past.
And I think when we talk about risk, right, we need to differentiate between this idea of sources of risk, right, that the economy falters, the meteors from outer space, right, that are potential sources, and the way we measure. And as we talk about measuring really as, kind of the idea here, when you look at individual positions, there's ways to get even more involved than just simply looking at how something bounces around. Maybe talk about bonds a little bit, some of the ideas we use there.
Yeah, if we get more granular and go into the bond side of the portfolio and say, well, how do we measure risk in bonds? Well, there's really two main tools that we like to utilize, and that's duration and credit risk or credit ratings. So if we start first with duration, what duration is telling us is how sensitive is your bond or bond portfolio to changes in interest rates. Now, what's different from standard deviation and beta and why duration is a great tool is it's actually prescriptive of forward-looking, right? So it's not telling you what has this fund done in the past or this bond done in the past in terms of reacting to price data, but it instead says, if this situation occurs, if we do have an increase in interest rates, what can I expect to happen to my bond portfolio? So that's very useful because it's a forward-looking measure. In many ways, credit risk is also a forward-looking measure. Credit agencies are giving AAA, AA, single A, different ratings to bonds out there, which signal, okay, this is what the balance sheet looks like for this business. This is what their cash flows look like. And that can give you a sense for how likely is default for this business. Generally speaking, the lower the credit rating, the higher the default risk. So we can use those tools to get an idea of what to expect going forward.
That's great on the bond side, and certainly I think what we often view as the more risky asset stocks, standard deviation and beta, which we talked about, are a great kind of introductory lesson, but I think there's some more instructive measures out there.
Yeah, I think we should take it a step further on the stock side. I think a lot of people just still rely a lot of times on standard deviation and beta. They're useful measures, but they're not very intuitive or relatable to investors. So let's say, for example, I told you the standard deviation of a stock fund is 13%. It doesn't really mean a lot to people. They don't really understand what that means going forward. What can I expect from this fund? So a tool I like to use is max drawdown. So for example, if we were to look at this stock fund and say, in its peak to trough, worst time period in history, it lost 28%. Well, that gives you a little bit of color of what you could expect in a bad scenario for this fund. That gives you a better idea of going forward, here's the risk that I'm taking if things don't play out or if we enter a market environment that it's not anticipated. So it gives you a little bit more color to just a 13% standard deviation number, which doesn't really give you much.
And I think, Chris, we talk often about, again, these sources of risk, but as we look at the measures of risk, why is it so important that investors have some of these tools?
Well, the tools are important because you don't want to dive into water without knowing how deep that lake is. You got to get a feel for what's around you, right? And as you build a portfolio, by having these measures of risk, whether that's duration or credit risk or standard deviation or worst drawdown, you can get a feel for where are the sources of risk in my portfolio and where can I balance these out. You're constantly measuring risk against the potential for return. So for example, if we took bonds, if I'm told that the interest rate yield on this bond is 3% and I have a duration of 2, well, I have an idea that if interest rates moved up 1%, I might lose 2% on the face value of that bond, but I'm getting 3% for the interest yield. So now I can measure and say, well, is that a fair trade-off in my book? Otherwise, you really don't know what your trade-offs are making. So measuring these risks gives you an idea of what the trade-offs are going forward so you can make decisions with open eyes.
And of course, put all this together, right? So we've got different measures for bonds, different measures for stocks, different ways that investors should think about measuring risk in their portfolio. And ultimately, that's the kind of thing that we use to build a truly diversified and balanced portfolio. Without the ability to measure those things, you lose the ability to really understand how those fit together.
Absolutely. You need to be able to observe the standard deviation of individual positions, but understand how that plays out in a portfolio as a whole. So a big part of modern portfolio theory is understanding that you could add 2 different holdings that have higher standard deviations, but if they're not correlated or they don't react in the same manner and go up and down in different times, well, you can actually lower the standard deviation of the entire portfolio by combining these assets. So that's what we're looking to do, right? We're trying to add assets that are not going to react the same to various market environments and have different sources of risk so that you're not putting all of your risk on one bet, whether that's interest rates or whether that's credit or whether that's the cyclicality of the markets. You want to make sure that you have assets that will perform differently in different market environments.
Chris, thank you for joining us today.
Thank you for having me, Kyle.
Joining me now, advisor with Landaas Company, Kendall Bauer. Kendall and I are going to be talking about the many ways we measure the return of our portfolio, whether it's looking strictly at the yield or the income that our portfolio can produce, or taking a broader view? Kendall, with the persistence of low interest rates, it seems only natural that investors might be looking for ways to get a little more yield out of their portfolio. We talk about the idea of yield, but maybe give me a little background on kind of what builds into this idea.
Yeah, I think first start with the easy definition of what yield is. An easy way to think about it is simply the earnings or income generated on an investment or account over a particular period of time, whether that's the interest on CDs or bonds, or even the dividends paid by stocks.
So let's focus for a second on that interest component of yield. And in particular, I'm struck by this idea that so many investors want to look for an opportunity to go from maybe some of those less risky areas, the savings accounts or CDs, where they're not getting much in terms of return, not getting much in terms of interest, and moving into some of those areas that may be perceived as a little more risky. How do you see investors trying to find ways to get more interest in their portfolio?
I think oftentimes when we look at the total portfolio percentage of stocks and bonds, people see bond rates maybe less appealing than what they're getting on the stock side of things. So they're looking to reach for yield when maybe it's not the best strategy for them based on their investment objectives. I think you have to be careful when you're looking to reach for yield in a low interest rate environment that we are in. It may be tempting to try to go for something below investment grade, a little farther out on the time spectrum, but you really expose yourself to more risk in the event that interest rates rise.
So let's talk about that interest rate issue, right? We have this tool called duration that measures the kind of bond price response to movements in interest rates. And we know that bond prices and rates move inversely. And so if in a normal environment you can get paid a little more interest to invest further out, right, to take the risk that the time risk, there's a tendency for investors to do that, but obviously that's one component. The other is credit quality, and we see investors often asking, could I reach for a little lower quality bond to try to get a little more interest?
I think when talking about credit quality, look back at last year as an example of why it made sense to be in short-term or even medium-term but high-quality bond funds. When money ran from the stock market last March, it didn't run to below investment grade long-term bonds. It ran to short-term, high-quality U.S. Treasuries, and that drove up the prices of those bonds that clients held. So it's important not to overreach into long-term below investment grade bonds, but to have that balance that fits what your individual investment objectives are.
And I think the risk, of course, for those lower quality bonds is that the corporations that are paying that interest don't survive in an event like we saw with the pandemic. And I think, that's the fear, that's the reason why people have focused on some higher quality, but it also speaks to the role that bonds play in our portfolio.
Yeah, bonds are your safe money. When you're looking at building a properly balanced, well-diversified portfolio, you want to take your risk on the stock side of the portfolio. The bonds are there as your safety net, like last year when the stock market has a correction. It gives you a place to take withdrawals from, and many investors or clients that are in retirement and that count on the income from their portfolio, it gives them this safety net to draw and let the stock side of their portfolio recover in the event we have a correction.
And so if it doesn't maybe make sense to take risk in bonds at certain times, how should we think about return within our portfolio if not to look at the income that it can produce?
I think you need to take a step back and look at the total return. So you need to look at yield, but there's often an overlooked second component to that being price appreciation. And given that we're in a low interest rate environment, price appreciation has been the driving factor for many clients' returns over the last 10 years or so, being that interest rates have been so low. So often yield gets the focus and people want to hone in on that, but it pays to take a step back and look at the total equation being yield and price appreciation.
Kendall, thank you so much for joining us.
Yeah, my pleasure.
We spend a lot of time discussing the various investment decisions that go into building a portfolio, but it's just as important to talk about what happens with that portfolio when something happens to you. Joining me now to talk a bit more about that is Mike Helzel. Mike, in addition to all the investment decisions that we help clients through, I think a big part of what we do is making sure that accounts, that money goes to the right places, that in the event of death, it ends up in the hands that it's supposed to end up in. Now, as we look at things like beneficiary designations as an example, there's a lot of critical things for investors to understand as they're looking at who they might want to name for beneficiaries on their various accounts.
Yeah, that's right. When it comes to estate planning or financial planning with your accounts that you have with us, the biggest thing is that you make who you want the money to go to clear and concise, right? It helps us when that time comes to hand the money off, and it also helps you have peace of mind that you know the money is going where it's supposed to be going.
And I think as we look at the clear and concise, it's one thing to have a very clear understanding of what you want. It's another to communicate that clearly in the various documents that are necessary to name beneficiaries. And so while it's important to have conversations with attorneys about trust planning, estate planning, those kinds of things, I think it's also important that what you want is what's properly reflected in those documents.
A lot of people have, outside of their investment accounts, they have trusts and wills and things of that nature. You want all of those goals to align, right? You want to go over those beneficiaries, just not on the big life events, right? Like, everyone has the marriages, the births, the deaths. You want to touch base with your advisor fairly often to make sure that while your life is constantly changing, those beneficiaries reflect the changes in your life.
And I think it's easy to make complex designations, right? It's easy to go, I've got this wonderful trust that we spent all this time developing, but it isn't necessarily the right way to designate beneficiaries for certain accounts. Sometimes it makes more sense to name someone specifically.
Yeah, it's correct. For your IRAs and your Roth, your retirement accounts, you want to name an actual person because then when the money gets transferred to them, it keeps its tax-deferred status. If a trust is the primary beneficiary of your retirement accounts, there's a chance it could lose its tax-deferred status, which is the last thing you want to have happen.
And of course, we work closely with tax advisors, we work closely with attorneys to make sure that we understand whether or not that would be the case. But again, I think it can be simpler sometimes just to name an individual. And so that comes down to individual circumstances. I think also important to remember that because each of these accounts that we're talking about has potentially different tax treatments, there can be different places you might want those accounts to go.
Absolutely. Big thing that happens now is called like charitable distributions, right? So because charities don't have the same tax issues that an individual person has, right? So a lot of people would like to give money from their IRA to charities. With your Roth IRA, because that's all after-tax money, you can give that to an individual person, a child, grandchild, spouse, and not worry that they're going to inherit some big tax burden later on.
And so I think we talk often about IRAs as the big one that we want to name beneficiaries on, but we don't have to limit ourselves to just those retirement accounts or those named retirement accounts. There's ways we can add beneficiaries to other accounts as well.
Sure, it's called a transfer on death or a TOD, and you can, for your retail accounts, and under retail you have your individual accounts, your joint accounts, and what that does is by, again, clearly naming beneficiaries of those accounts, it helps you avoid probate and any issues after you're gone.
And again, I think stressing the importance that you can put a beneficiary on just about anything, but it's important for individuals to have a conversation first and foremost with the people that are helping them make those plans, but then also potentially with the people who might be receiving those assets so they know what to expect.
Later in life, it helps to bring your beneficiaries into the conversation so they know what's going on, right? So they also, I've used this word a lot, very clear plan on like what they're going to be receiving and how it's going to affect them. Because when they inherit the money, they're going to have a lot of questions. So the more clear and concise answers you can give them, the better off they'll be.
And I think as we look at the big picture here, I think important for investors to remember that as much as the investment piece is an important overall part of your financial life, this other piece of it, right, the naming beneficiaries, the making sure that we structure this all correct, may be just as important, if not more important, because it's the one piece ultimately that you lose control over once you pass.
The beneficiary piece of it doesn't get talked about enough, in my opinion, because it's so far off in the future, right? You're in retirement, you're working towards retirement. You often don't think of the beneficiaries. But naming those beneficiaries, again, clearly, I've said the word numerous times here, I can't stress that enough. You name them clearly, it's going to just eliminate all speed bumps in the future and make it so much easier for the people that you want to have this money able to get this money as easily as possible.
Mike, thank you very much.
Thank you for having me.
Thanks everyone for watching our 2021 Landaas Company Investment Seminar. We appreciate your business. We appreciate our relationships with you. We look forward to seeing you at the firm in the near future.